All right. Hello, everyone. This is chapter 2. We're going to be learning about key levels, why they are important, how they work, and what are the different dynamics behind it or them. Firstly, before we get started, this is a slide directly from chapter 1. We need to understand why is a key level important before we even start chapter 2. As we know, there are 5 different CRT conformations. A timed CRT range. This is a specific 4-hour candle, a specific 1-hour candle, a specific daily candle, etc. Timed turtle soup. A specific candle of the day is turtle souping a CRT range. Thirdly, the high time frame key level. This in itself, as well as the timed turtle soup and the timed CRT range, are the 3 highest probability confirmations that you can have when trading CRTs. Fourth, CRT plus inside bars. And fifth, basically a low time frame CRT within a high time frame CRT. So basically, this means if you have a timed CRT, a timed turtle soup, and a high time frame key level, this is an extremely high probability setup. And if you have a lower time frame CRT within a higher time frame CRT, you increase the probability. Same thing goes with the CRT and inside bar. The reason Romeo and Sham spend a lot of time referring to key levels is because it is in the top 3 confirmations. If you want to avoid losses, only focus on these 3 confirmations. So, a lot of you guys have been asking, what is a key level? And there are a lot of people commenting on my YouTube videos, DMing me on Twitter, Telegram, etc., asking what a key level is. First off, they have gotten the answer, but not deeply. I will give you guys the answer. A key level is only important if you can locate an entry model. What does that mean? If there is no CRT while we are hitting a key level, that key level is not important to you. Sure, price will react from it, but you must find an entry model at the key level, or else you do not execute. If there is a key level that is bearish and you do not see a CRT, you do not enter short. Okay. Using a high time frame key level to validate CRTs will raise your win rate. As we know, it is a confirmation. There are many different key levels on your charts. Many. And they form every single day on all time frames, right? A key level is simply a higher time frame PD array or high and low. Let's say you are on a 15-minute time frame, your key level will come from a 1-hour time frame. If you are on a 4-hour time frame, your key level will come from a daily time frame. We will learn about these time alignments later on in this lecture. For now, keep in mind that key levels are relative to the time frame that you execute on. Key levels come from the higher time frames, like I have just said, relative to the time frame that you enter. I just said this. All right. So what is a key level? I've said PD arrays, higher time frame PD arrays, which is a high time frame fair value gap, a high time frame breaker, a high time frame order block, a high time frame rejection block, and all other high time frame PD arrays. I'm not going to cover every single PD array. ICT does that in the core content. High time frame highs and lows are just as important as the rest of these PD arrays. Not any high time frame high and low, but the daily, weekly, and monthly highs and lows. Those are all key levels. How do you find them? If you want a daily high and low, you go to a daily time frame, pick a specific high or a specific low, and extend your line out. Same thing with the weekly, same thing with the monthly. Finding the key level. When looking for your CRT ranges, spot the higher time frame key levels below or above the candle range low or candle range high. Below or above meaning if you see a CRT form, right, and your high time frame key level is above and has yet to be hit, you want to wait for the high time frame level to be hit before even considering an entry. That is if the higher time frame key level is above when you are bearish. If the higher time frame key level is below within that CRT, it can still be used as a high probability confirmation. Write that down. That is very important, and where some people tend to be confused on the topic. So as I mentioned before, if you are trading a 15-minute CRT, your key level will come from a 1 hour. Sure, it can also come from a 4 hour and a daily. Finding the key levels is simply just as easy as dividing by 4. What does that mean? If your key level is coming from the 1 hour time frame, 1 hour divided by 4 is 15 minutes. If your key level is coming from a 4 hour, 4 hours divided by 4 is 1 hour. So you have a 1 hour CRT and a 4 hour key level, a 4 hour CRT and a daily key level, or weekly or higher, a daily CRT and a weekly key level, or monthly or higher, a weekly CRT a weekly CRT and a monthly key level, or yearly or higher. Yes, there is a higher time frame than the yearly. We want to see explosive movements when key levels are hit. Now, this doesn't always happen. I want to make it clear that we can consolidate into a key level. We can have multiple taps of a key level. And it is not uncommon for a key level to be tapped more than once. We'll talk about this later on in the lecture. So here's a perfect example of what a key level may look like. On a 4 hour time frame, we see a 4 hour PD array. This is a fair value gap, a bullish fair value gap. On the 1 hour time frame, we can see a clear CRT. Now, if you remember from this slide right here, this one right here, high time frame key levels below or above the candle range low or candle range high. In this example right here, the key level is above the candle range low within the CRT. It is still valid and still high probability. Why? Well, first off, you would not be entering when this key level has been tapped here. Why? There is no CRT. However, once this candle closes and we see the next candle close, meaning the second candle in the CRT range closes above the low, we wick below and close back above the key level. Write that down. Third candle opens, manipulates lower into an order block, FVG, breaker, whatever you enter on. expanding higher. This example right here is a clear and direct to the point example. So if you want to screenshot this and add it to your notes, you should be doing that. So 4-hour PD array, key level, 1-hour CRT. Remember, 4 hours divided by 4 is 1 hour. 1-hour CRT. Find your entry model on a lower time frame, right? 1 minute or 5 minute, and enter long. When? For beginners, I recommend entering after the open of the third candle. And for the more advanced CRT traders, you are more than welcome to execute a trade on the second candle. As I've mentioned before, it is not unusual for a key level to be tapped more than once. In the next slides, we will learn why and when this happens. A lot of you guys may fall victim to being stopped out when trying to trade a CRT based off of a key level. We're going to learn why you guys were stopped out and how you can avoid it. So how exactly does price react to a key level? There's only 3 ways. Only 3. 3 ways that price can react once a key level has been hit. Reaction number 1 is a V-shape. And I want to make something clear. Romeo has gone over all 3 of these. So if you have gone through his UTS or any of his mentorships for that matter, you will remember what I am saying here. Reaction number 1 is a V-shape. Reaction number 2 is a W or M shape. And reaction number 3 is a range, also known as WWW or an MMM shape. The WWW-MMM is the name Romeo gave the shape in UTS. Before UTS, it was known as a range, right? Ranging into a key level. Hence why I was telling you that price can consolidate into a key level. I have told you guys this. And that does not mean you should be executing. This reaction in itself is the lowest probability reaction that you can execute on. What does that mean? Avoid this. Avoid a range into a key level. Your goal is to catch the W or M shape or the V shape. All right, the V-shape reversal is the easiest of all 3 to spot. It's basically in its name. It's visually easy to understand, and price will literally create a V-shape. There's nothing more to it. The key level is hit once, and price immediately reacts and pushes the price upwards or downwards. That is what you want to be catching. Now, the W or M shape reversal is the most common way that you will see price react at a key level. This is also why I said a key level can be hit and often is hit more than once, usually twice. Write that down. This kind of reaction will create easy to spot turtle soups. Sometimes you will see an SMT appear. What is that? One pair or asset turtle soups a high, while the other creates equal highs or lows, hence the name MM or WW, right? An M is formed like this, right? High, low, high, low. You got 2 highs, equal highs, or relative equal highs, right? SMT, ES creates a higher high, while NQ creates equal highs. That is a reaction off of a key level. A turtle soup into a key level increases the probability of your trade following through, right? It is a high probability confirmation. Now, the WWW or MMM shape reversal presents the most unfavorable conditions that a turtle soup trader will ever experience. The key level is hit multiple times, sometimes 3 times, sometimes 4, sometimes 5, sometimes more. This is why I really advocate that you do not execute when price is ranging into a key level. If you are not experienced, you will be stopped out many times, and you probably already have. You've probably blown accounts. This is why a low time frame CRT within the higher time frame CRT is also an important confirmation. It will help you avoid getting stopped out while price is ranging into a key level. Write that down, as Romeo Norsham will tell you this. I will repeat, okay? A low time frame CRT within a higher time frame CRT is an important confirmation when trying to avoid being stopped out while price is ranging into a key level. Write that down. How does price react to a key level? Okay, the V-shaped reaction will cause explosive price movements. Price will, if bullish, will be electrocuted by a low and immediately run through highs. In a bullish scenario, we will see price hit a higher time frame key level and immediately abuse the highs. In a bearish scenario, we will see price hit a higher time frame key level and then immediately abuse the lows. Abuse the highs and abuse the lows basically means breaking highs and breaking lows. Remember, this is a key foundation to turtle soups. In a bullish scenario, we reject lows and break through highs. In a bearish scenario, we reject highs and break through lows. It is important to identify the key level and its reaction correctly in order to avoid getting stopped out, as I have mentioned in the previous slides. Repetition is key to practice. All right, specifically with the WWWMMM, also known as a range reaction. During the range reaction, the key level will be tapped multiple times. Avoid it as much as you can. The next step is reviewing how price expands to your target from the key level. Each reaction has a sequence, all of which are similar but different in its own ways. This last part is important to understand. Sometimes a key level is hit and will expand quicker than another reaction, meaning the V-shape reaction will expand quicker and in a different manner than a range reaction will. Same thing goes with the W or M-shape reversal, equal highs or equal lows. Each of the 3 higher time frame key level reactions, also known as dynamics, will cause price to react in a different sequence, drawing towards liquidity. That is very important to understand. If I lost you, rewind it and re-listen. Study this. So here's an example of a W or M shape reaction, right? We have a key level, higher time frame key level, tapping it once, twice, turtle souping into a key level, and price reacting, pushing higher. So this right here is the W. So remember how I said equal lows or relative equal lows? Well, this is a relative equal low. Okay? Now, if price would have pushed lower, right? So we have a low, a lower low, and if price did not make a higher low and instead made a lower low, well, then price would have simply had a range reaction. Three taps, or sorry, three lower lows into a key level. It's the opposite, vice versa, when bearish. Okay, so if this made a high, this made a high, and this made a higher high, that is a range reaction. You do not want to be trading that unless you are experienced and have studied using the lower time frame CRTs within the higher time frame CRTs. Now the W and M shape reaction are not hard to spot. They are relatively simple and easy to catch. This right here is a WM shape reaction as well. Now, I don't know if there was a key level on the left side. However, if there was, this would be considered a W or M shape reaction, right? We have one high, a higher high, lower high, expansion lower, relative equal highs. This is an M shape, right? This is a W shape. Lower low, come back higher, lower low, up higher. Same thing as the W. Now, of course, it will not always form like this. Sometimes it will be perfect equal highs. Sometimes it won't. It will look like this. It will look like this. There are many different ways. However, you must be versatile and understand that price is not set to always create equal lows or always create equal highs. There are different ways a W or M can form. So this key level reaction is a V shape, right? We have a key level 1 hour order block dropping down to a 15-minute time frame to look for our entries, or CRT for that matter, not entry, but CRT. First off, there is no CRT here. Why? This candle did not create a lower low. Now, if there was SMT with the opposing pair, then you can execute a trade long. Now, I would much rather you guys execute the trade when a CRT is actually available. Does that mean you cannot execute when there is SMT? Of course you could, but make sure to backtest and practice it. Do not start executing SMTs on live accounts if you haven't practiced them. Why? Trust me, you will be stopped out more than once. All right, in the beginning of my career, when learning SMT, I decided it was a smart idea to dive straight in and not even front test, rather start applying SMT live into my portfolio, into my trades. That was not the smartest idea. I then convinced myself to take 3 months off and practiced SMTs, front running them. Of course, I'm not a huge fan of backtesting. However, I love front testing. Anyways, practice SMT if you are going to execute. Back to the key level reaction. This right here is what shape? Clear as day, right? A V-shape reaction, hitting a key level on a 1 hour, a 1 hour key level, hitting the key level on the 15-minute time frame, bang, breaking through the high that caused the purge. So breaking through a high that rejected a low. V-shape reaction. Very visible, very clear. These are the reactions off of key levels you do not want to miss. They are quick to expand. Now here we have an example of a WWW or MMM or a range reaction. what does this look like? So there is a daily fair value gap on the left hand side. This PDRA is the key level, dropping down to a 3-hour. You could have used a 4-hour as well. I just wanted it to be more visually appealing to you guys. So you can see key level tapped, key level tapped, key level tapped, key level tapped. We have 1 high, 2 high, 3 high, 4 high into the key level. Now, does this mean you cannot trade this? Of course not. You can trade anything on your chart, but you must practice the range. You must practice lower time frame CRTs within the higher time frame CRTs, and I will not explain any more than that until you guys have practiced enough. There is indeed other ways to determine whether or not price will range in the Q level, but that is for a later time. For now, understand that a low time frame CRT within the higher time frame CRT will save you a lot of money. I wasn't going to add this in, but why not? Yeah, you guys deserve this, right? A lot of progress from what I've seen, at least from the ones that are vocal, right? I would love for everybody to be texting and learning together. However, I cannot control you guys. You have your own lives and have your own personalities, which is acceptable. So the little tip is there are specific times or periods of times or time slots where price ranges, and there are specific times where price will expand. Price moves from expansion to consolidation, expansion, consolidation, expansion, consolidation. That is it. That is all I am going to tell you. Rewind that, write it down, and study. It is important to note that the key level can be above or below the CRT or within the CRT itself, right? I explained this at the beginning of the slideshow of this lecture, and I will repeat it once more. The key level can be above or below or within the CRT itself, and the probability does not change. They are both high probability. So, what does turtle soup look like on the lower time frame? The highest probability lower time frame turtle soup will always form when hitting a key level, as it needs to be in the same direction of the higher time frame order flow. Very important. This means the highest probability turtle soups will always form when hitting a key level, a CRT plus a key level is the highest probability turtle soup that you can execute. Write that down. So what higher time frame order flow are we actually referring to when I'm saying this? The high probability low time frame turtle soup will align with the higher time frame candles order flow. The higher time frame candles order flow. Focus. You want to find the power of 3 within the higher time frame candle. The lower time frame turtle soup will align with the higher time frame power of 3. How to understand a high time frame candle's order flow. To understand how a high time frame candle operates, we must first learn the power of 3 and obtain a complete understanding of it. Most of you already know what the power of 3 is. It is a simple and direct to the point concept. If you don't know it and have not mastered visualizing it yet, you should do so now. I would even recommend studying the power of 3 before key levels. There is the power of 3 in every single candle on your chart. There are unlimited amounts of backtesting or front testing that you can run to help your brain visualize the power of 3. Head to a daily chart and backtest. Identify each of the 3 stages of price delivery. For those of you who already know what the power of 3 is, or also known as AMD, this may sound rather boring and repetitive, and it is, but it is important, very important. So stage number 1 is accumulation. This is a range, consolidation. Phase number 3, stage number 2 is manipulation. This is the Judah swing that ICT refers to. I want to slip in a little tip. The manipulation is part of the range. It is part of consolidation. And distribution, stage number 3, is the expansion. So price will range, Judah swing, expand. Every single candle, right? We have an open, low, so open, consolidate, low created, that is the Judah swing, that is manipulation, expansion, high, and then close. Open, low, high, close. That is the power of 3. So here is a example of the power of 3. We have a 4-hour fair value gap as our key level. And we have the turtle soup forming on the lower time frame. As you can see right here, we hit the key level, turtle souping a lower time frame liquidity pool. Right, so on the 1-hour time frame, the key level came from a 4-hour. Pay attention, nothing is random. 4-hour key level, 1-hour turtle soup, 1-hour CRT, if you guys can see. Price is not random. So, can this be the turtle soup, right? The turtle soup of the CRT? Yes, it can. Can this be the turtle soup? Sure. Regardless, you need the key level to be hit before even considering an entry model. So we have accumulation, manipulation, distribution, power of 3, while hitting a key level and forming a CRT. I also want to mention there is the power of 3 within every single CRT range. We have the range, accumulation, second candle, manipulation. Where do we manipulate? Into a key level, into a lower time frame liquidity pool and a higher time frame liquidity pool. The higher time frame liquidity pool is the key level. The lower time frame liquidity pool is the turtle soup. Write that down. So some extra tips when looking for the power of 3. The opening of a new candle is where you will find a high probability turtle soup, not at the end of an old candle. Now, why am I emphasizing this? Price will open. Let's take a look at this, for example. Price will open, manipulate higher when bearish, expand lower. You will not catch the manipulation or the turtle soup if you are entering at the end of the 1-hour candle, meaning if you are entering at 10:50, you are likely to catch a loss. Now, if you are entering at 10, then you are likely to catch a win. Why? Because your goal is to enter at the beginning of a new candle, the opening of a new candle. If bullish, you enter below the candle. What does that mean? Price will open, drop lower below the open, find your entry model, enter long. When bearish, price will open, manipulate higher into a key level if high probability, and then expand lower. So here's a tip. Try buying at the opening of new candles, not the close or end. This is repetition on purpose. This is not random. Okay? There is two sentences right here that are the exact same for a reason. Many of you fall victim to hesitation. This is why front testing is more important than back testing. Now, if you study this, if you front test this, you will become a better trader than 90% of the people on Twitter. And I am not exaggerating. I am not trying to fluff your situation up. I am not trying to make you guys feel good. I am being direct and honest. If you can enter near the open of a new candle while a turtle soup forms, you will have a much higher win rate. But for that to happen, you need to front test. Why? Because if you do not front test when a candle opens and turtle soups a low when bullish, you will fall victim to hesitation. You will hesitate and not enter. So here's a small recommendation. Backtest the open of a specific candle hundreds of times. Then, once the sequence is drilled into your head, start front testing and executing buy or sells at or near the open of new candles once the correct turtle soup forms. This entire slide should be the one that you pay attention to the most in this lecture. Remember, price will open, consolidate, manipulate, and expand. When bullish, we manipulate below the open of the candle into a liquidity pool. Higher probability would mean a low time frame liquidity pool and a high time frame liquidity pool. And 4, expansion to the DOL for the current leg. A high probability turtle soup will always expand quickly and violently from current price levels at a specific time. That in itself is a V-shaped reversal. A high probability turtle soup will always occur at specific times. That is why time is very important and comes before price. The highest probability and fastest turtle soups to play out will always be a false breakout of a range. That is the turtle soup. So here is an example of the daily candle. We are on the daily time frame, Euro US dollar. Daily open, daily close. What happened? Keep in mind there is a key level up here. And this is a CRT in itself, as you guys have probably noticed. Now, if you did not spot this CRT when I opened this slide, you have a lot more studying to do. Sorry to burst your bubble. You should not be going out on the weekends if you are Clearly, you are not understanding CRT if you have not pointed this out from the moment I switch slides. First off, why is this CRT? Candle range forms, accumulation. Second candle manipulates the high into a key level, high probability CRT. And next candle will likely distribute to the lower end of the first candle. Now, that's not the point of this slide. The point of this slide is to understand how the power of 3 actually functions within the daily candle. Now, the power of 3 is within every time frame candle. However, it is easier to visualize on a daily. How do you visualize it? Draw the close and open of the daily candle, any daily candle. Head over to a 15-minute time frame and visualize the consolidation, the manipulation, and the expansion. From here, we clearly understand price opened, consolidated, manipulated higher into a key level, and distributed lower, ultimately closing. A 15-minute time frame, key level hit. We open the daily candle, consolidate, manipulate into the key level at a specific time, and distribute lower into the close. These two slides right here are very important. If you cannot understand the power of 3 on a daily time frame, then you will not understand the power of 3 on the 4-hour or 1-hour. Start with the daily, if not weekly. Now, this is a slide from chapter 1. I was going to backtest with you guys more, right? So this was supposed to be a live session, but it is not. And rightfully so, you have a lot of studying to do. And I want you guys to prepare your questions for the next Q&A. As I know, you'll probably have a lot of questions regarding key levels. The 5 a.m. model is one of the easiest models that you can ever learn to execute. So I want to make this clear because if you are a struggling trader, focus on a 5 a.m. model, right? A 5 a.m. 4-hour CRT. Wait for a 15-minute CRT at the highs or low or of the 5 a.m. CRT. And wait for the purge to happen during the 9 a.m. hour up until 10:30. Lastly, enter when the second candle of the 15-minute CRT closes or off of a order block. This setup forms multiple times a week. If you choose one model out of every single model that I have released, this should be it. Trust me, you will thank me later. Now, if you are studying the 5 a.m. model, recognize the power of 3 within the model. This will form within the 5 a.m. model. It is your job to study it. That is all. This was a quicker lecture and direct to the point. No bullshit, no ranting about random things. This was the most direct I can possibly be about key levels. It is your job to study, backtest, and front test. Gather your questions and talk to me soon. With that being said, get to your charts, backtest and study what you've learned, and I will talk to you soon.